It's been pretty spicy this week with all the talk about the proposed 50-year mortgage that President Trump and Bill Pulte brought up last weekend. I read about it last Sunday. I was going to do a video on it earlier this week, and I wanted to wait until I've talked to people about it, got their thoughts, waited for other mortgage professionals to weigh in on this, and of course, all the social media influencers and YouTube content creators. And the majority of what I'm hearing and seeing out there is that people hate it. And the primary gripe is because of how much interest you would pay over the life of the loan as a homeowner with a 50-year mortgage. My initial thought on this was I don't know anybody who stayed in the same loan for 30 years, much less 50. Over the last 25 years, I think I've known a couple who stayed in the same mortgage for 15 years to pay their home off because they had a very specific goal. So that's something that's few and far between and kind of a moot point, in my opinion. And most homeowners will refinance their home or sell within 5 to 7 years, depending on the situation. So rates come down, they refinance for the lower payment, lower rate, or they use equity in the home for a cash out refinance to pay off debts, or they sell the home to upsize, downsize, or they're relocating for work or family. So it's very unlikely that we would ever see anyone stay in one of those loans long term. But from a perspective of affordability, that could be a great tool to help homeowners or home buyers get into the position of being a homeowner. And I wanted to see what it looked like. So I put together some numbers and I wanted to share these with you so you can understand my point of view as well. In the Pacific Northwest, the Seattle area, I'm using a rent versus own scenario with $3,000 a month for rent, which is pretty average around here, and a $700,000 purchase price as an example with 5% down based on a borrower with a 740 credit score and 40% debt to income ratio. $3,000 a month, obviously paying rent, you're not gaining any equity. The only benefit is you have a roof over your head. That is it. And purchasing a home on a 15-year fixed, your total monthly payment, including property taxes, insurance, and mortgage insurance, would be $63,1802. A 30-year would give you a payment of $5,005.48, and then a 50-year fixed would give you a payment of $4731.21. And the payment difference between the 30-year and the 50-year is $244 a month. And for some, that may be enough of a tipping point to pursue purchasing a home because home ownership is something that they want and they're tired of renting and they want to they want their wealth to grow through home ownership. So going a little bit further into this, I have done the analysis based on what it's going to look like in 5 years. So in 5 years as a renter, you would pay almost $200,000 in rent. And this is with a 5% increase year over year, which is pretty common. So you've paid $200,000, you have nothing to show for it, just a place you've lived. On a 15-year, you would have paid $161,000 in principal down, which is significant. On a 30-year, you would have paid $43,000 in principal down. And then on a 50-year, you've only paid down $9,500 in principal. However, in that 5 years, you've gained $281,000 in equity. And that's using a 6% year over year home value increase, which is moderate. And then in this case, I've also taken the $244 a month payment difference from the 30 to the 50, and I've put that into a S&P index fund showing an 8% rate of return. The average over the last 45 years is 10. So I'm not using a best case scenario. And that S&P index fund paying into that $244 a month, they would have an additional almost $18,000 there. So their combined net worth would be almost $300,000 rather than giving up $200,000 to their landlord to grow their net worth. My opinion on this, I believe it's a great tool that can be used. Again, it comes down to the strategy, how long they plan on staying in the home. If it's less than 5 years, great. We will, use this as a tool to get in. And depending on where you're at financially, year after year, once we do those annual mortgage reviews, it may make sense if rates come down to refinance out of that 50-year into a 30-year if it's going to lower the payment. If they still want the absolute lowest payment, maybe refinance into a 50 if there's enough of a benefit there. If they're going to be in the home longer than 5 years, let's look at a strategy of paying off or paying down the principal balance as much as possible, using it as like a forced savings account. So you're growing your equity on both sides, not just the annual appreciation, but how much you're paying down of the principal balance. So that's when we'd have those discussions about, does it make sense to refinance from a 50 into a 30, or maybe their financial position has changed quite a bit and their focus is, I want to pay the house off as quickly as possible. So maybe look at a 15 year. So using it as a tool to get in is, I think it's fantastic, but it really comes down to the strategy. So who you work with is just as important as the strategy you use. These are things I do for all my clients because I want to make sure that when they walk in the door of their home, that they have absolute certainty of what's in front of them. So if you have any questions about this, need anything, let me know. Otherwise, have a fantastic weekend, and I will talk to you later.